we talk about the option in this theory, and then I know that the option is actually sold by some individual person, but I found that there are some companies, some bank, they will sell something like an option to the customer. There is another term called warranty or something. So,
a warrant?
Yeah.
A warrant.
So what is the difference between the option and
a warrant?
Yeah, the warrant.
Okay, let me say what I think it is, and then I'll double check right now, because I think this is one of the... I think a warrant is a kind of an option where there is some extra clause in it, where you're allowed to turn it into stock. Okay, or a warrant... Are you talking about are you talking about a warrant, or are you talking about something different?
I think it's warrant.
Warrant. Okay, what I believe a warrant is, let me just double check that, is a bond that you can convert, it has some kind of option to convert it to stock. Let me just double check this.
So it's actually issued by a company.
Warrant, an option issued by a company. Okay? Call warrant, by a warrant is an option issued by a company or a financial institution. Call warrants are frequently issued by companies on their own stock. Okay? So if I'm going to interpret that, what I'm going to say a warrant is you could imagine Google selling call options on Google. Okay? Why might it want to be able to do it? Well, one thing is that Google can certainly always make good. Google has a lot of Google shares. By definition, the company owns a certain amount of its shares, right? Or it can create more shares, right? So a warrant is an option it can sell that maybe it's good for the company because it can create, it can sort of pay off from it, not from cash, but by creating more of its own stock. Okay?
Because I found that most of this warrant is actually provided by this investment bank and then Straddle.
Right.
So they actually get some sort of investment Straddle. They provide a lot of warrant in Hong Kong, for example, and people are basically worried about that, whether the warrant actually still valid or not.
Okay. So bottom line is, okay, so I guess the short answer is that there are a lot of different, okay, the short answer is that there's lots of different kinds of financial products, okay, and some of them start to get complicated, and I'm not going to talk about warrants. Like I said, are a kind of a company where there are, I guess it looks like you have the opportunity, because a company is issuing it. It can pay itself off in stock. It can satisfy that call by issuing stock rather than by buying stock someplace.
From my point of view, I just think there is like a kind of option, okay, that you can buy it, and then there's a strict price, and also there's a duration.
Right.
Yeah, basically the information is just like option. Okay, you have the right to buy or to sell that stock at a particular time at a particular price.
Okay. Based on what I see here and what I'm discussing with you, I will say that doesn't sound wrong. What I will say is that there's a class of financial securities, and I picture warrants as being in that category. There are convertible bonds, okay, where they have more complicated structures, where instead of paying off money under certain circumstances, they will pay off in stock. Okay? And those sometimes have advantages or disadvantages. These are examples of what I will say more complicated securities than we will talk about. Okay? But the way when I think of warrant, what I think of is the company can somehow pay itself off in stock. The thing can be paid off by issuing stock rather than just by paying off bonds. Okay? So an example of such a security might be, maybe let's say I take a loan. Okay? I write a bond. Let's say you don't trust. Let's say my company, DigiScam, is going to, wants to sell you a bond or a loan. You might not think I can pay you back. But perhaps if I add a clause in there which says that if I don't pay you back, I will give you half the company. Okay? Now this bond looks more attractive than it looked before. Right?
Oh.
and that now has some of the structure of a company being able to write stock and pay off by issuing stock instead of by paying cash. Okay? And so I picture warrants as in this category.
Basically, not a guarantee.
It's another way of guarantee or another alternate form of payment. It may be a guarantee or it may be a form of payment that may be easier for the company to make. So what if I give you a bond where let's say I sell you a bond, you loan me $1 million, and I have the choice of either paying you back $1 million plus interest or 10 shares of DigiScan. Okay? It's easier for me to pay off by issuing stock, shares. So exactly whose benefit that is not clear. Okay? What I will say is the basic pricing principles are presumably governed by the same kind of theory that we're talking about. But these are just more complicated deals. That's how I would put it. Okay, any other questions? Any questions about the world now? Or any questions about anything in class? Anything financially going on in the world that is interesting? Okay? Any questions about options? We talked about options last time. We're going to continue to talk about them. We're going to be living in an options world for a while. So we should get used to it. But any questions about anything from last class or anything about the world at large? Okay? One thing I find is that a lot of people ask interesting questions after class. Okay? This is actually a good thing. It would be good if people asked interesting questions in class, because other people, I think, probably would find them interesting. Okay, so if you have ideas, sort of things that are in your head, I'd be happy to answer them. Any questions? At least talk about it. Any questions? Yes?
If AIG declare bankruptcy, what about their insurance assets? Because people buy insurance from this company.
Okay, again, this AIG thing is a complicated thing, and I'm not, I know what I read in the newspapers about it, but let's just think about it. In the principles of what we've talked about here, we talked about how there are various mechanisms insured in place in all these exchanges and all of these transactions to make sure that people will ultimately get paid. It is, and that's where insurance sort of comes in. Okay, I buy life insurance. Okay, and I know the company is very happy to take my checks every time I write a check to them. The question is whether they will be happy to pay me back if I die. Okay, and so it's important that there be mechanisms by which people have confidence in these things. Okay. And so a lot of the reason why there was suddenly a takeover of AIG is that there were a lot of these sort of deals where they were somehow the guarantor of this. And the fear was that if they went under, suddenly a lot of deals couldn't happen. Okay? Or a lot of people be worried about, oh my God, I had this deal, is it good or not anymore? And so that's what I gather was the reason why it was taken over. Okay? Clearly they felt an urgency to do this that they didn't feel with Lehman Brothers. Okay? And presumably the reason is because it was a guarantor of a large number of things. Okay? And the fear is that it would cause more turmoil. Okay? Any other questions? Okay? Again, interesting things happening in the world. Okay? Any questions? Okay, so what I wanted to talk about here, we started talking about this last time, but I want us to get more serious here about understanding how you can build things with options. Okay, so we've defined what stock options are. Okay, we should have the basic idea of what a call option is, which means that you have an option to buy it at a fixed price, or a put option, which means you have an option to sell it at a fixed price. Okay, and again, there's a notion of either you own the option or you sold it, in which case you're on the other end of the deal. But there's this whole field of financial engineering. I don't know if anyone's ever heard that word. That's a good buzzword. You are in an engineering school, okay? What do financial engineers do, okay? Well, one thing that they would like to do is to take this raw material of these investments that you can do and put them together in ways that they build something new, okay, out of them. And what's interesting is that by combining put and call options and ownership of securities in interesting ways, you can build more complicated investments that have interesting properties to them. So let's take a look at how we might build more complicated investments from these basic things. So a bull spread, okay, is one that, if we look at the curve over on the lower left, okay, that's an example of what we mean by a bull spread. It has a payoff function which is flat below a certain K1. It increases linearly to a point K2 and then goes flat again beyond that. Okay? That's what we're going to call the desired shape of a bull spread. Okay? That means that basically you sort of believe the stock will go up, but you want to protect yourself against it going down too much, and you're willing to take a hit if it goes up more than you thought. Okay? So it's limiting your upside gains and your downside risk. Okay? And, giving you a linear payoff in between. Okay? How can we realize a payoff function like that? Okay? The idea here seems to be, what if we buy a call at a strike price of K1 and sell a call, okay, with a strike price of K2? What is that investment going to look like? Well, here we've got our, let's say, profit diagram. If I buy a call with a price of K1, what is that going to do? As of K1, anything above K1 is profit, right? And that would be my payoff function from having bought the call. Is that right? What if on top of that, I now sell a call function option at K2? What would my payoff function on the sold thing be? Okay? If I sold the call, what's going to be my profit function? Okay? It would be neutral so long as the profit price was below K2, right? And from then on, what would happen? I would lose money linearly on that call, right? Because I sold it. So my payoff function would be something like this. Does that make sense? If I have both of them together, what is the sum of my portfolio going to look like? Okay? But before K1, there is no action, right? If the price is below K1, okay, I get no money from the call I bought. I lose no money from the call I sold. Does that make sense? So basically, the sum of them is going to look something like, I guess, yeah, all colors. Something like that. Does that make sense? Over in this range, from K1 to K2, the call that I bought is in the money, right? The call I sold isn't, right? So my portfolio is, I get to take advantage of the increase up till there. Does that make sense? And what happens at K2? Now for every dollar above this, I continue to make $1 from the call I own, but I lose $1 from the call I sold. Does that make sense? So the shape of my payoff function is going to be to look like that. Does everybody see that? I get my, what would we call that shape? Okay? Answers, we would call it a bull spread. That's what they tell us to call it. Okay? Any questions? Now the question is, so does everybody agree? I think everybody should feel, or if not, I want to know, does everybody agree that the shape of owning the call, going long on a call at K1 and short on a call at K2 yields this kind of a payoff curve. How many people see that and understand that? Raise your hand. Okay? Now the only other question in trying to determine this price, it seems to me, is where is it relative to the baseline of 0? Does everybody see that? Okay, there's now going to be, depending upon the relative amounts that you paid for the call and how much you sold the call for, this whole curve is going to shift up or down. Does that make sense? You paid for a call here and you sold a call here. Okay? And the difference between them, okay, is going to govern whether or not this curve shifts below 0 or goes above 0. Does that make sense? If the current strike price was here, which one of these options is going to be more valuable? Okay? Let's think about this. Would you rather own a call at a strike price K1 less than K2, or own, basically, if we flip this thing over, which is the absolute value of the profit going to be greater than? Okay? The call issued at K1 or the call issued at K2? Okay? If this is the current price, let's say that you get the absolute value of the payoff of this thing. So forget about the sign. Okay? You have this long call, short call, right? The absolute value of this would be that, correct? Now, which security would you rather own the absolute value of? This one or this one? Okay? Clearly, this one is going to keep going up like that, right? The option that is closer to the strike price now is the more valuable option because it is more likely to get into the money than the other one. Does that make sense? So which should be more expensive? If this is the current strike price and you're determined to get a bull spread, which is going to be more expensive? Somebody buying this call option or somebody buying this one? It's buying this one, right? Now you bought this one and sold this one. Wasn't that right? So in fact, your total proceeds from this operation will be negative. Does that make sense? And so I would say that the payoff function on this, if you want to be right, would be something like this, where this is the difference in the price of the two options, the one we bought and the one we sold, okay, and then it traces through the payoff function that we had in mind. Okay? How many people think they get that? Any questions? Like, I don't get it. Okay? Any questions? Okay? What's interesting is, okay, we can also get, I claim, build this kind of a bull spread in other ways. Can we build a bull spread like this from puts instead of calls? Here, remember, we bought a call and we sold a call. Okay? Can we do this with puts? Yeah? Question first, yes.
I would like to ask whether the cost of K1 is always more expensive than K2 at any time.
Is the call for this more expensive than the call for that?
For any time.
Let's think about that, okay? And I think you may be right, okay? But let's think about this. Here, clearly, okay, if a call option, okay, if the strike price is below, we've shown that the strike price is below all of these, this is clearly going to be worth more. What if the strike price is above it? Which option is worth more? is it going to be, so here we now have, if the spot price is this, right? This option will have value positively until the price dropped to here. Does that make sense? This option would have price value only until there. So yes, if you have two calls, the lower priced call has to be the more valuable of the one, regardless of where the strike price is. Okay, does everybody see that?
But if the current strike price is very low, then the two options may have low difference in the worth.
Well, there may be, but that's if I give you a choice. You have a choice of buying, I'm giving you a choice. You can buy a share at $50, or you can buy a share at $55. Is there any reason why you would want to buy it at $55 instead of $50?
Yes, but maybe at some moment, both options may carry low value too, practically, because their strike price is...
No, they may have both low value, but I want you to talk about a monotonicity property. Okay? If I give you a choice of, if I give you a call option, whenever anybody gave you a call, you're supposed to say an option, you say thank you, right? But now you have a choice. If you have a call option at $55 versus a call option at $50, obviously you would always prefer the option that lets you buy it at a cheaper price. Does everybody agree with that? Okay, so in principle, this one is always going to be, okay, more expensive. This option, the option at the lower strike price, is always going to be more expensive than the other one. I did the original analysis because what if the case strike price was low? If the spot price was low. But clearly it should be true for wherever the spot price is. Any questions? Now what you're arguing here is, I have an option to buy Lehman Brothers today at $100 a share, okay? Or an option to buy Lehman Brothers at $200 a share. Which is worth more? By our argument, clearly the one that is worth buying Lehman Brothers at $100 is worth more than buying it at $200. Your argument is both of them are nearly worth zero. And that's also true, okay? But we still expect that the price of this call has to be more expensive than the price of the other one. Okay? Any questions? Okay, yes?
But how about if they have different expiry dates?
Now, if they have different expiration dates, that is a different business. Okay? But let's think a little bit about what we think is worth more. Okay? Suppose I give you the same option. I give you an option to buy, let's say, Google at $500 in December 09 versus one that lets you buy it in December 10. The strike price is the same. The difference is the date. Okay? Which of these options is going to be more valuable? Okay? The one that will expire soon or the one that will expire in the future more? Okay. The answer is, clearly, let's say if they're American options. Let's start thinking about this thing. Clearly it's a no-brainer, right? You're saying I can buy it any time between now and this date, right? Could it possibly be worth less if you let me buy it at that price for a longer period of time? It's more freedom, right? More freedom is going to clearly be worth something. Okay? It can't be worth nothing, right? So clearly an option is going to be worth more the longer it is in place. That's an important point to see here, right? The lower the strike price, the more valuable the option, a call option. The longer the time period, the more valuable the option. Okay, the longer till the expiration date. Okay? Now what happens if one is higher and one is lower? Well, that now starts to be complicated. And that's why pricing options is a complicated business, and we will look into that more later on. Okay, but the basic monotonicities as far as strike date and strike price and expiration date should be clear.
What about for European options?
What about what?
European options.
What about European options? Okay.
Is that always that the earlier the expiration date, the lower the price?
Okay, let's think if we can come up with a proof for this. It seems clear to me that it should be true. Okay? But now let's just think if we can come up with an argument that's firmly true. Okay? So it seems clear to me that if I have an option, I guess, okay, let's say I believe I believe it is clearly true, okay? But I don't know if I have a simple proof for this right now, okay?
Do you need some, for that, you need some model of how stock prices change?
You probably have that.
You have to have some kind of continuity model, continuous model of value motion, continuous model of how stock prices move through options.
Okay.
To get the nonsense.
Presumably that is true. We will look about pricing these things. So let's say I would, between me and you offer me the longer European price, I would duration, I would take it. It's not as obvious to me, I can prove that to you right now. But we'll look at, when we start looking at how you actually price these things, when we start looking at these more complicated, I think we will see that that's presumably true. Any questions? Okay? Fair enough. Now, can we make a bull spread from, what's it called? Let me just look ahead for a second. Is it possible that we can do it by buying puts? Okay? Here we did this by buying a call and selling a call. Is that right? Is there a way we can do this with a put? Okay? How might we be able to do that? Okay, does this make sense? Let's think for a second. Okay? A put, remember, if we buy a put, what is the payoff function for a put? Okay? It would be something like this. Is that right? So what if I were to sell a put here? Does this make sense? If I sell a put from here, what is the payoff of that going to be? Okay? Selling a put from here, the payoff function is going to be like that. Does that make sense? How can I now offset over here? So here, suppose I now sell a put at K2. That gives me this side part of the shape. Is that right? How can I now offset it at K1? What do I want to do? If I now buy a put at K2, K1, they will offset each other. Does everybody see that? So what's interesting is I can make this kind of a shape of profile. Okay? Either way, by buying and selling calls or buying and selling puts. Does that make sense? Okay? Which is better? Well, to my mind, it's unclear. Okay? There might be different issues involved. Okay? One might be that for some reason the cost of the puts might currently be selling differently than the cost of the calls. Okay? Although by arbitrage type things, those probably shouldn't be too far out of whack. Right? There are also different issues that when you buy and sell puts, at certain points you have to put up margin and stuff, right? At certain things you have to put margin up. Okay, whenever there's danger of you losing something. And depending upon, there might be considerations there. But either way, it should be clear that we can make the shape from puts or calls. Okay? Any questions? Okay? And that's,
question?
yes.
So the margin are only for the put option? So for the call option?
Well, let's think about it, what it is. It's not a question of only for puts or calls. It's whenever I can take a bath, whenever I can get into trouble. Let's look at it this way. Here, I bought an option, right? If I bought a call or bought a put, I can't go negative, can I? So there's no reason why anyone is going to want to, I don't need to put up any margin for that, right? Here, okay, when I sold this call, from that moment on I could lose money on this investment, right? So whoever sold me the call has to somehow be convinced that I can pay it. Whoever, when I sold this call, whatever the market is that's insuring this thing, okay, he's going to have to make sure that I can cover these losses, right? That's where margin issues would come in, okay? Now maybe you could instead say, but wait, I've got this other call that I own, and that's going to protect this. But that's between you and whoever's giving, issuing these requirements. Do you see that the reason why you would require margin is if you can go negative and somebody else can lose money, okay? And it would have happened when you sold the call or sold the put, okay? Any questions? Okay? But those are the shapes of these things. Okay? Good. Now a bear spread would be one where you want to make more of a profit when the price goes down. Okay? That's if you look at the payoff here for our bear spread. Again, we limit the upside and downside. But we're making profit, okay, when the price, sort of more profit when the price goes down. Does that make sense? How can we build a bear spread from the tools that we have at hand? Okay? If I want to make this kind of a shape, what should I do? Okay? What kind of raw materials might give me this kind of a shape? Okay? The easiest one to me when I look at this is I say, what if I were to buy a put at K2? Does that make sense? Buying a put gives me something that looks like this, right? Put, long. What about here? What if I sell a put, okay, at K1? Beyond here, both the one that I sold and the one that I bought are both in the money, right? And they're neutral, okay? Here, I'm only benefiting from the one that paid long, the one that I bought, and here both puts are out of the money, okay? And so it is flat. Does everybody see how I realized a bear spread from buying puts, buying and selling puts? Any questions? Could I do it by buying and selling call options? Does anyone want to propose a way to do it by buying and selling call options? Way to do that? Okay. It says here that I could sell a call at K1. Here was a call at K1, right? If I bought it. If I sold it, it would go down like this, right? So suppose I go sell a call at K1 and buy a call at K2. That would also do the trick. Does that make sense? How people sort of get it? How people find this boring? I see people getting a little carried away here. Okay? On one sense, it's arithmetic. On the other hand, it's kind of interesting because somehow you have the ability to make these shapes from the shapes that you can buy. This is call and put options. Any questions? You can build more complicated things. A butterfly spread is one where, if you look at the shape of that, the profit is highest around K2. It drifts down from that and eventually becomes flat, right? Why might you, suppose let's say that the current strike price is around K2. Why might you want to buy a butterfly spread? Okay? You would be profiting then from the stock doing what? Going up? No. Going down? No. Sitting where it is, right? Does everybody agree with that? So if you have a company that you think nothing interesting is going to happen to, okay? That the world is going to forget about this company, okay, over the next 3 months, okay? There's not much action either way. A butterfly spread would be a good thing to buy. Does that make sense? Okay, it would be a company that we think might not do very much over the next the next 3 months. So we're going to make up an example here. Okay? Is there a business that seems to be somehow very unaffected by everything that's going on in the world? Okay? I don't know. Computers? Okay, computers seem to me to be pretty unaffected by it. I'm just making this up. Obviously everything's affected by it. But airlines are certainly more affected by what's happening with oil, right? So computers are probably going to be a relatively calm place. Okay? If I believed that. Okay? And I just made it up, so don't necessarily believe it. But if I believed that maybe a butterfly spread would be a good thing to do now. Right? Now, how can I profit? How can I make a butterfly spread? Let's think about that. So that it pays off if the stock doesn't change. Okay? The idea is, okay, suppose we buy, there's going to be 3 prices of interest on our butterfly spread. Okay? One in the middle is K2, which in the explanation I'm talking about, I picture as being something like the current price. Right? K1 is the lower price, K3 is on the other end. What happens if I buy a call with K1 as my strike price? I will get a payoff like that. Is that correct? What if I now, okay, buy another call, okay, with strike price K3? Then a way to think about it is if I just own those calls, I have $2 of gain for every gain beyond here, right? I have $1 of gain for everything in between, and no gain for everything here, right? What if now I were to sell 2 calls, 2 of them here? That is going to produce a slope, that's 1. This would be a slope where I'm going to be losing money twice as fast, right? Because I now have sold 2 call options, right? So this in here, in this range, for every dollar above it, I am up 1. For every dollar in this range, I am down 2. Okay? No, I'm not down 2. I'd be down 2 from here plus 1. Is that right? So I'm really down 1. And for everything in here, I'm up another 1. Meaning here my price is neutral. Right? So what is the payoff on this thing? It is going to be 0 up to here. A slope of $1 per unit change in strike price. A slope down of $1 per unit strike price. And a slope of 0. Does everybody see that? So what's kind of neat is now I have a world where I can profit if in the future the price stays near K2. Okay? Any questions about that? Okay. Any questions? Should the price of these things, what should we know about the shift of this curve, up or down? We know that this call option, I mean, do we know anything about monotонicities? We know that we bought a call option here at an A option. We sold a B option, 2 B options. And we bought a C option, right? The prices of these things are going to be what? Clearly, A is going to be worth more than the absolute value of B, worth more than the absolute value of C. But it's hard for me right now to tell you. I don't think I can tell you. So we know whether this plus this is bigger than this than those two, right? That determines whether or not the curve shifts up or down. Is that right? I guess we have to presume that the curve is going to have to shift down. Why do we know the curve has to shift down? This is an interesting question. Why do we know that, in fact, the costs of A plus C minus 2B, how do we know that the costs of, we paid for these two, we got these two back. How do we know that those have to be greater than 0? Because the whole payoff function here is positive, right? If you told me that I could guarantee a positive payoff, plus you're also giving me money to do that, okay? That would be the argument that I created this money, right? And it would be a short thing, it would be an arbitrage type of a deal, right? So the truth is that for this kind of a thing to work, the cost of the options, presumably, that we sell are going to be less than the cost of the options that we buy. And this curve is going to shift down. So it is somewhere like that. Any questions about that? Okay, how people sort of get it? Any questions? Okay. So it's neat. I can profit if I know that the stocks are going to stay where they are. Okay? And again, this is just sort of an explanation of what we were doing here.
Sorry, I'm just,
Yeah.
it would seem like we've got to weight it somehow because, can you go back to the butterfly?
Yes. Let's go back here.
Because as the spot price gets larger, what you're doing is you basically have two curves that you're, okay, no, I got it, sorry.
No. Remember that all of these options, the price of any put or sell option, the shape of it has to be neutral below it, and then something of slope 1 above or below the strike price. Okay? So the shapes of these curves have the slopes that I described. The prices of the options, okay, are seemingly a little murkier to deal with, although we are going to get into option pricing for a reason. Okay? But this guarantees the shape of that spread. Any questions? Okay? So if we want to if we think it's going to stay everything where it's going to stay, we can profit it from it. Any questions? Now, let's look at this payoff function down here. Okay? What we call a straddle. Okay? In the straddle, there's a strike price, a price K, and if the price gets significantly above K, we profit from that, right? If the profit gets significantly below K, we profit from that also. We only lose if the price stays where it is. Okay? So can anyone imagine a world where we might know that the company is going to go up or down, but not know whether we know it's going to go up or down? Okay? We know that it's going to move, but we may not know which direction it's going to move. Okay? Can imagine a situation in the world where that's going to happen. Okay? Let's look at what possibility would be a lawsuit. Okay? We know that right now that let's say that are there any two companies fighting in a court case that's important for them now that anyone's aware of? Okay? Certainly right now there's a question of Microsoft and Google are fighting things out, sort of over Yahoo's fate, right? Google wanted to get into bed with Yahoo in some way, and Microsoft said this is illegal, this is anti-competitive, right? Now, eventually there is going to be a ruling. Yes, Yahoo could sell its soul to Google, or no, it can't. Okay? In which case they will probably have to go scurrying to Microsoft. Right? We know that one way or another, the day after they announce that court verdict, Yahoo is probably, Microsoft is probably going to go up or down dramatically. Okay? Google will go up or down dramatically. But we don't know who's going to win. If we know who's going to win, that's even better. Okay? But we don't know who's going to win, right? So maybe we would profit from a straddle like this. Does that make sense? Okay? Another possibility might be companies that are ready to announce earnings. You don't know if it's going to go up or it's going to go down, right? Maybe that's a time when there's likely to be a big swing right after you announce it. Okay? Any questions? Okay? Or the best example turns out to be drug companies. In the United States, drug companies, it's very expensive to develop a new drug. What's a fancy, important new drug that people have heard about recently? Okay, I know many people follow this medical industry. But let's say Viagra. Let's say Viagra was a big deal. Everybody knows Viagra, right? You get spam. Okay? There was a time when there was a company that was developing Viagra, right? And they said, we have this great stuff, people are going to want to buy it. But there's a question of, before you can sell it in the United States, you need to have, it has to pass certain levels of tests to get government approval. They've got to prove that it's safe, and they've got to prove that it's effective. And if you know that the FDA, the Food and Drug Administration, is going to make an announcement tomorrow as to whether or not Viagra is going to be approved as something that they can sell, either for the company that owns the rights to that, either it's going to go shoot up if they say yes, or it's going to shoot down if they say no. Does everybody remember that? Does that make sense? So this would be a good case where you would want to do a straddle. Okay? But how can we do a straddle? Any questions about why you might want to buy this? Okay? Now, can anybody think of how you would realize a curve like this? There is a strike price K. You want it to go up if K goes up. If the price goes above K, and you want it to go up if the price goes below K. How can we build a portfolio to do that? Any ideas? You can buy calls, you can buy puts. You can sell calls, you can sell puts. What would do it? What would be one way to do it? Okay? If I want a curve that's going to do something like, well, forget about the offset of these things. That's going to go up in both cases. If this is K, what kind of call option would I want to buy? If I went long on a call at K, then my payoff function would be this, right? How would I get this part of the payoff function? Buy a put. Does everybody agree if I now also buy a put? The put is that. So what if I buy a long call and I go long on a put at K? Then I profit in either direction, okay, from movements at K. If the price goes above K, the call was worth money. If the price goes below K, the put was worth money. Does that make sense? which way does the cost of the options go? Do I have to pay for these options or do I get paid for them? Since I'm going long and buying these options, it's going to cost me money, right? This looks like a great game, right? Again, profit in both directions. The only way I can do that is by paying a cost of the two options, the buy and the put, which shifts it down. Okay? Any questions about that? So it's neat. I think it's going to go up, I can buy. I think it's going to go down, I sell. I think it's going to stay where it is, I butterfly. I think it's going to move in one way and I don't know what, I put on a straddle. Any questions? Okay? So again, I picture the, when you see in movies of these stock brokers or stock traders, you always see these guys sitting at terminals, sweating and wearing these white shirts which are open and seeing lots of screens. What they're basically doing, in my mind, is they are trying to figure out which of these operations they want to do based on the world and making a trade to try to take advantage of that. Okay? They think that they know something about the world. There's ways they can specify profit in any of these directions. And again, I want to say an infinite number of ways you can combine these things. Okay? What if, let's say, instead of buying one call and selling one call and buying one call and buying one put, what would happen if I bought two calls and bought one put? What would my profit situation look like then? Okay? Which would it be here? A strip or a strap? How many people say strip? How many people say strap? Okay? Well, if I own two calls, do I want the price to go... If I own more calls than I own puts, do I want the price to go up of the stock or do I want the price to go down? I want it to go up because the calls profit from going up. So basically this would be a strap, it looks like, right? Because my slope up is now twice as fast as the stroke going down. Does that make sense? By changing the constants here, I can profit more steeply or less steeply, okay, from up or down movements. I can play any of these games I want so long as I'm willing to buy those options, okay, and pay what it takes to buy them, okay? Any questions? So the more I play those kind of games, the lower the cost function drops, okay? And the more that I would lose if the price doesn't move, right? I'm pulling my V down, okay? Any questions? Another one that they did have in the book they describe as a strangle. A strangle is one where it looks like what I'm going to do is profit, okay, from big movements in the price. Okay? The straddle was, remember, I was going to profit from movements in the price, but here it's flat for a region in between. Okay? How can I realize a strangle? Think about it. Where at K1, I start going up if it gets below K1. I start making profit if it gets above K2. How would I go about realizing one of those? Okay, does anyone want to suggest how I could make one of these? What option should I buy? You're selling that thing that at K1 you want me to sell a put. Okay? Well, selling a put is going to give me what kind of a payoff function? Selling a put would give me this. Is that right? Does that look like something I want? Okay. What if I bought a put at K1? Right? If I bought a put at K1, then I'm going to have a payoff at K1, that's if I, basically go long on a put, right? How can I get the move at K2? What do I need to do? Yeah? Long on a call at K2. Does everybody agree with that? Basically, it's the same idea as my straddle, except that I push the options apart, right? And again, because I bought these two, they're both going to start out underwater in that range, right? Okay? And then hopefully fight their way back, okay? Any questions? Now, why might I want to own one of these instead of a straddle? Remember, a straddle was going to pay off both movements from K1. Why might this be better than this? Okay? Well, let me put it on a different chart just to make clear. Why might this be better than this? Okay? We're here, let's say it's K1. Why might I prefer to own this, go and do this instead of that? The biggest reason I can think of is that the options prices that I bought are going to be lower, right? Here I am buying a call at a higher price than I bought before, right? Here I am buying a put at a lower price than the one I bought before, right? So the cost of doing this is going to be less than the cost of doing this, right? And so what's different here is that this distance is going to be less than this distance. The cost of doing one of these is going to be less than the cost of that. And it's going to be more cheaper the further apart I put those things. Okay? Any questions? So, the interesting thing about this whole line of work or thinking about it is that, in fact, somehow, once you decide what the market conditions will be, what it is that you think is going to happen in the world, by using options, you can profit from basically any kind of prediction you can make. The way I think that you should think about stock prices is as a natural thing. If you want to say, what are stock prices going to look like in a year from now? What is Google's price going to be? You would probably be dumb to make a prediction. I think Google's price is going to be $563.32 a year from now. Why? Because the odds that it will be exactly that is wrong, right? Very small. What you really make a prediction is something about a probability distribution. Does that make sense? That there is somehow a probability. Here's the probability. There is going to be some kind of a probability function of what is the price of Google going to be. Let's say it's going to probably look something like this. Okay? Maybe there's some chance that Google's going to implode. Okay? But, maybe they decided to buy a lot of Lehman or something like this and didn't tell us. Okay? But bottom line is there is some kind of a probability function of what you think is going to happen in the future. And whatever you think that is, in principle, by using options properly, you should be able to take advantage, if you're right about this probability of distribution, you should be able to take advantage of it in a best way by by using options in an appropriate manner. Any questions about that? Now, in theory, actually, you could realize any desired payoff function. This was a probability distribution. We have seen that there are payoff functions. Let's say you took some kind of a Picasso drawing or whatever you wanted it to be. Here's a function. In principle, if you wanted to have something that will pay off like that, okay, as the strike price varies, here's the strike price, right? As a spot, as the price, as a spot price, the price a year from now. You could imagine any desired payoff function. you want to realize. In principle, you can realize that shape by options. If you can buy options at any price point that you want, any strike price, buy and sell options at any strike price. Because if you look at it, the bends in these curves all require you buying and selling in order to make a bend in one of these payoff functions. You need to buy or sell an option there. Does everybody agree with that? Otherwise, it's just sort of, you can't make a bend here just by, if you're not allowed to buy anything at that price, right? Now, it turns out that you can't buy on options exchange, options at any possible price, strike price. Because remember, on options exchanges, there's standardized things. We talked that, you can go, you can buy them at, let's say, at $2, $2.50, $5, things like this, okay? But bottom line is that you have the freedom to shape a wide variety of different payoff functions, okay? Okay? From the options that are sold on exchanges, okay? And since this is a computer science class, one thing that might be an interesting algorithm problem would be to figure out, given that you've got a choice of options out there that are sold for a particular price, and given that you have a shape that you want to bake, or a prediction of the probability distribution, it now becomes an algorithm problem to try to figure out what's the right way to buy these things. Okay? Any questions? Okay. Any questions about these kind of options or portfolios? We talked about using options to hedge, right? What would be an example of me using an option to hedge? We talked about it a little bit. Suppose, let's say, that I have a share of Google, okay? My payoff function from Google. This is my current stock, the current price, the spot price, right? If it goes higher than that, I will get paid. If it goes lower than that, I will lose money, right? How can I hedge myself against it if I'm afraid it's going to go down? What can I do? What should I do? Buy a put. Suppose I buy a put here. Now then, if it sinks below this, I'm covered, right? Is this a good idea or a bad idea? The answer is, of course, it depends, right? I am protected and I can sleep better at night. That's what hedging is, right? I don't have to worry about Google imploding. On the other hand, I will have lowered my total payoff function. Because why? Because I had to pay for this option, right? Okay? And so, although I reduce my risk, I in principle also somehow reduce my expectation. Okay? Because I have to pay for this option. Okay? So hedging does not increase expected returns. Okay? It somehow reduces the risk, it reduces the variance. Okay? And therefore, in principle, reduces the return, the expected returns. It doesn't mean it's not a good thing to do. Okay? But that's sort of the trade-off that we have. Any questions about that? Let me show you one other kind of portfolio that you can build from a combination of options that is kind of interesting. Okay? And it's called a calendar spread. All the options we've talked about right now have to do with buying and selling options with the same expiration date. What happens, as I guess we had an earlier discussion here, what if I buy, I can go onto an exchange now, I can buy options to expire this month or 3 months from now. What happens if I build a portfolio, okay, of 2 options where I have a put and a call, okay, at the same strike price, but at a different expiration date, okay? This now starts to get a little more complicated. In fact, one primary reason it's complicated is now I have to start drawing things in 3 dimensions. So far we've talked about options as paying off only with a strike price dimension, right? If we also have a time dimension, it gets to be a little bit trickier to think about. Does that make sense? But let's look at this thing. A calendar spread does what? Okay, it says I'm going to sell a call, okay, at strike price K. Okay, let's think about it here. Here's my call. I'm going to sell it, meaning my payoff function is this, K. So I have done this, and this is at date D1. And I am also simultaneously going to buy a call at this price K, at the strike price K, for a date D2, where D2 is later than D1. Okay, do you see what the portfolio is? I have sold an option at K that will expire earlier than the one that I bought. Okay? Any question about what the portfolio is? Okay? If D1 was equal to D2, what would my portfolio look like? What would my payoff function look like? What would it look like if, in fact, there was very little difference, no difference between the expiration dates of these things? If I had sold a call at K and bought a call at K, what would my payoff function be? It would be completely flat, right? I'd be completely insensitive to the price movements, right? But in fact, that's not quite what I'm doing here. There's going to be a gap here. So my question is, let's now think about what the value of this portfolio is, okay, on D1. Okay, I see I'm getting puzzled looks here. Any question about what the portfolio is? I have sold a call at D1 next month and bought a call with the same strike price 3 months from now. Okay? So it becomes active at a later date. Which one of these calls is going to cost more? Okay? Which one? Okay? This one is more valuable, right? Or more expensive, right? Because it expires later, right? So the total cost of this is going to cost me something to do it, right? But let's now think about it. What is the payoff on D1 as a function of the strike price? Okay? Suppose that on D1, the spot price, is this. Okay? Where it's below K. What is the value of this option that I sold? Okay? On the expiration date. What's it worth? 0, right? On the other hand, what is it going to be worth, the option that hasn't expired yet? Okay? But this is the one I sold. If this is the strike price here, if this is the spot price on D1, right? This one is worthless. This one, though, still has value. Does that make sense? And the higher this is, the more value it has, right? So the value of my portfolio somehow below K, okay, is going to somehow go up, okay, as I approach K. Does that make sense? Because this thing is still out of the money on D1, right? This thing is still worthless at any price at the expiration date, so long as the spot price is less than K, right? But this is going to become more and more valuable the higher it is, right? Now what's going to be worth here? Okay? The higher the spot price is here, okay? What's this going to be worth? I'm going to be losing money here, but my option should correspondingly be worth more. Does that make sense? Okay? And so, once we get greater than this, okay, as the price gets beyond this thing, both options in the money are offset each other. Oh, but let's think what it means to be out here. The more dollars from here, it's not that it's sort of worth more, it's that it sort of offsets each other. Right? Because if you think about it, every dollar of payment that I lose here is a dollar that I gain here. Modulo the fact that the call is going to be worth more because I have extra time. Okay? So what is the shape of these things? Okay? If we look at it like this, okay, the claim is that a calendar spread looks something like this. Okay? And that you can build I guess the point of this exercise is to note that I can build complicated payoffs by changing the times of expiration, as well as the combinations of puts and calls. Okay? Any questions about that? Okay? So I'm not going to talk more about these kind of options now. But recognize that I have the possibility of playing games by dealing with options with different expiration times. Okay? And there can be advantages or disadvantages. There can be payoff functions that get built out of that. Any questions about that? Okay? So there are a lot of different games and stuff that I can play here. Okay? If I put my mind to it. Okay? And that's sort of a large part of what financial engineering is. There are ways I can use these different options to build payoff functions to my specifications. Okay? Any questions? And there are all kinds of other options that we can talk about. Okay? Which we're not going to talk about very much. Okay? We talked about American and European options. There are other, even more complicated options out there. There are things called Asian options. What is an Asian option? The payoff for an option is not going to depend upon the price at execution, but the average price over a period. So let's say that I have an Asian option. I might say that I will pay you, if I have an Asian option, I will pay you, the difference, if the average price between, 2008 and 2009 is greater than or equal to $100. Okay? This is a more complicated kind of a thing. The way to think about options right now is, if I have an option that's got a strike price of K, okay? If I've got an option that has a strike price of K, and this is the price of the stock as it's going through its daily courses. If this is the expiration time, if I have a normal call option, here I would make money on my call. Does everybody see that? Because the only thing that mattered was the price at the time that I executed it, right? That's the kind of options we've been talking about. You can define more complicated options. One you might say is that instead of saying that the price at this time is equal to somehow what the price is at that moment, we take the prices being the average of all the prices, right? And for this particular stock, the average was probably closer to here. Does that make sense? So with an Asian option, you're sort of betting on what will the average price be over a period. And this is clearly a more complicated thing. Okay? Does that make sense? It's not only a question of what is the final value, but it's what the trajectory is. If the price was like this, if basically the option was like this, a stock that did this would have had a bad Asian option payoff. A stock that did that would have a good Asian option payoff, right? So there are all kinds of other complicated options here, okay? But in principle, our goal is to sort of try to find out what the price of these things are. The more complicated the instrument, the more difficult it is to calculate the real price, okay? And that's why, in some sense, the more complicated options exist, because they create more differences in price between people's perception of them, and therefore more trading. Because trading in principle only happens when people have different ideas of what something's worth. Any questions about that? Okay? Fair enough. What I'd like to do for the last few minutes of class is pass out a description about the semester projects. Okay? Just to start people thinking about that. So please take this back. I put it on the website. So start passing these back. What I want everybody to do, I have said that 20% of the course grade in here is going to be on a semester project or presentation. Okay? I want people to start to think about what it is that they're going to be doing. Okay? By October 9th, which I believe is 3 weeks from Thursday or something like that, I'm going to want to get a proposal from everybody of what they're actually going to be doing. Okay? I encourage you to work in groups. Okay? A typical group size probably should be 3 students if I have to make it up a number. Okay? And there are 2 different, what I will say, classes of projects that I would think about. There's projects and there's presentations. Turn the sheet over. Okay, look at the presentation topics. This is one thing that I would say I would like to see groups start to think about doing. I want some groups to give 20-minute presentations about practical issues related to some of the things we've been talking about. What are the tools available? What are the databases available? And give us an introduction to these kind of things. These will be 20-minute presentations. And 20 minutes will be enforced. I will pull people off the stage after they run longer than 20 minutes. And your job will be to create a presentation and a web page showing what you have, basically giving your slides, giving whatever links to whatever resources you have on these kind of things. And I give details for each of my intended presentations in the syllabus. So if you want to get together with somebody and form a project group and say, hey, I would like to get my project over with quickly, I would encourage you to pick a presentation, and preferably one at the beginning of the list, because I have them roughly in the order. Let's say perhaps roughly in the order of how I want them presented in class. Okay? So that's one option for groups. Another option is that maybe you have some great idea of what you're interested in and you want to do some kind of a project on. And if so, you can come by and talk to me. Okay, I am willing to listen. The other option is that you pick one of the projects that I have listed here, okay, as being projects that I think might be interesting to do. Now, the rapid response team has already filled up. So if you're on the rapid response team, they responded rapidly. They have already filled up that team. Okay? So they don't want more of them. But other ones that I might want to see are, number 2, groups that work in building what I would say trading agents. Okay? And for doing this, I want you to have some kind of a programmatic access to some kind of an online market. Okay? And that involves a certain level of programming. Okay? And to make sure you have a good API to sort of communicate with these markets. The next two, 3 and 4, revolve around things like I talked about today. How can I write algorithms to come up with the right portfolio to buy, to realize a payoff function? Okay, that involves things like linear programming and probably and integer programming and things like that, or maybe computational geometry techniques. So those are sort of algorithmic type things. If you're into that, that's good. Another possibility has to do with doing time series analysis. Okay, and I'd like to see people maybe build projects around constructing libraries for time series matching. Okay, and shape similarity and clustering and things like that. Okay? So what I encourage you to do is to sit and think about these projects, which ones you want. Okay? Make sure you find your group and make sure you have a sense of what you want to do. Once you think you know what you want to do, okay, send me mail and we can arrange a time to chat about it. Okay? Any questions about projects? The projects here are 20% of your grade. That is non-trivial, but it's also not infinite. Okay? So that may help modulate what the level of work that you put into this kind of thing is. Okay? Any questions? Okay? It gives you an opportunity to do something that might be interesting to you. And I'll be happy to talk with you. I want you to read it and think about it and go back to the syllabus for the lecture topics. Okay? And then come by and talk to me starting next week. Okay? Any questions? Okay, thanks for your attention. And next week we'll get into options pricing. Okay? Any questions? Thank you.
Theoretically, is it impossible to make the portfolio with no loss?
Is it possible? The question is it possible theoretically to make a portfolio that guarantees you no loss? I would say the answer is yes. And it's called a mattress. Okay? A mattress is something that you sleep on, right? They used to say stuffing money in a mattress means that you lift up your bed and you hide it underneath the mattress so no one can steal it. Here's if you have cash. Cash in principle is a lossless portfolio, right? Okay, but there's no upside to it.
You lose, right? With inflation?
With inflation, you would argue you would lose, okay? But perhaps if you put it at the risk-free rate, risk-free means no loss, right? Then that would cover the issue of inflation, okay? But there's no upside over that. You're saying, is there a way I can guarantee myself great returns with no risk? And my answer for you is to talk to the people who used to work at Lehman, okay? And that will give you some answer to that. Any questions? Okay? Talk to you about this next week. Okay, bye-bye.